Hi there, Nancy. Yeah, I mean, to be honest, I'd probably describe it as one step forward and one step back, but I very much know what you mean. It very much has felt like we're engaged in a very elongated tango, to be honest, with these negotiations. So, to be honest, I'm not super concerned. I think it's inevitable. The difficulties of actually getting agreement from the various interests and protagonists in terms of this negotiation means that it was always likely to be quite fractious, quite difficult to analyse right up until the last. I think history has shown that these sorts of negotiations with Europe, it's almost inevitable that both sides have to be almost dangled over the edge of the cliff to see what the alternative looks like before really they're motivated and incentivized to make the necessary sacrifices that will be required to get a deal. So I still fully expect that we will end up with some sort of withdrawal agreement over the next few months, which facilitates the transition agreement for the next 2 years, such that we can fully discuss the trading relationship. But to be honest, the certainty around that always remains, or the uncertainty around that view always remains pretty high for obvious reasons.
Let's just take your base case assumption, though. If we do get that deal in time, what happens to UK equities first?
UK equities is an interesting one because, again, if we go back to the post-referendum period, there were lots of expectations, from markets running into that vote that if we did indeed vote to leave the European Union, that risky assets would suffer. And actually, what we saw in the UK was quite the opposite. And the main reason for that was the currency. The UK equity market does indeed source a lot of its revenues from overseas. It really is more of a global index than it is a UK index, and so the FTSE 100 benefits when sterling falls. And I think it would be the case again that if we were to get a satisfactory agreement that was able to pass Parliament and be signed with the European Union, that would be a boost for sterling, and so you might actually see UK equities going sideways or even underperforming, in spite of the fact that from a growth perspective that would be a relief for the UK domestic economy. You'd probably expect to see the FTSE 250, which is a broader index and has more domestic focused businesses. That would probably be where you'd see the good news being priced.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now, to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.